One.
Hello and welcome to BQ Prime. I'm Elara. Very good afternoon to all the viewers. One sector that is in focus is the real estate space. And to add a cherry on the topping is the RBI, who has come up with a pause with regards to interest rate hikes. How well this is going to augur for the sector, not only from a purchasing and investment perspective, but also from the equity side of it. To discuss this, joining us on the show are Gulam, Senior Executive Director at Knight Frank India, as well as Rupesh, Sankhe, VP at Elara Capital and Realty. Welcome to the show, gentlemen.
Good afternoon.
Good afternoon. Gulam, my first question coming to you is, overall, if you go to see, the last 18 months have really augured well for the sector, and the real estate market, specifically residential, has been on a strong recovery path in the last 18 months. From there on, if you divide it into segments between luxury, affordable, as well as mid-sized, it's mainly luxury which has been really doing well. The other two, there has been some bit of slowness that has been witnessed. Overall, what's the sense that you pick up if you have to add the cherry on the topping now with the pause coming in from the RBI?
Let me first of all, Hiral, put up some aspect on this market segmentation, get some clarity on it. To start with, when we say that super luxury is doing well and the rest of the sectors are not doing so well, etc., let's put things in perspective. You know, the super luxury or high end of the market does not constitute more than 2 or 3% actually of the overall transaction. So if our focus is only on that, I agree that that particular segment has been doing exceptionally well. But that said, the other segments are not doing bad. Look at it this way, even the worst performing sector, which is the lowermost segment of the market, is also growing in the last whatever 6 quarters that you referred to. The rate of growth is not as spectacular as the upper end of the market that we are referring to. So if the upper end of the market has been growing at 20-30%, and that's the reality, because the super luxury or the upper end of the market was actually down for almost about 6-7 years with no takers. But suddenly, on the other side of COVID, that sector has found buyers like never before. And hence, the growth of that sector has been spectacular. But it doesn't mean that the other sectors like mid-segment or the lower segment are not doing too well. Of course, the rate of growth is not that good, but growth nonetheless. And mid-end, let's look at it this way, mid-end, which constitutes almost about 45 to 50%, has also done well at 7-8%, 9% growth quarter on quarter is a fantastic result. It's the lower end where we don't really see that much of a excitement building up. And the reason is pretty simple, you know, because the rate hikes, the home loan interest rate hikes bothers that segment the most. You know, when you're talking about super luxury, when you're talking about say 10-20 crore plus kind of apartments, how many of them are really depending on home loans alone is a question. Of course, it's a wealth creation. Lot other options are coming in when you're financing those apartments. But at the lower end, the options are minimal. Most of them rely only and only on home loans. And that is where the impact is being felt the most. So in these last 3 to 4 quarters, when almost about 250 to 300 bips of a rate hike has happened, the worst hit, obviously, is the lowermost segment. So just to put this in perspective, the way I would want to put it up is that the markets are doing well democratically. It's only the super luxury which is doing exceptionally well. The mid end is doing fine. The lower end, I would want it to do well. And coming to your pause, you know, when you talk about pause, well, the damage is done. You know, when you talk about 275 to 300 bips of an increase, the lowermost segment is already hit by it. So if you want to turn it around, then you have to actually see the things turning around from the rate hike perspective as well. So if it is pause, it is not really a breather or a something to cheer about or sing and dance about, at least for the lower end of the market, where you would want to see it turn around to some kind of a reduction in home loan interest rate has to happen. Till then, this pause is not going to contribute much to the sector overall. Over to you, Hiral.
Right. So overall, clearly what you're saying is that we will have to see the cycle reverse instead of a pause to have that
Indeed.
material impact, right? Now,
Indeed,
taking
indeed.
your point into consideration, Rupesh, coming to you, if you have to see it from a market perspective and the way companies have come up with their, Q4 business updates as well, how would you correlate it? And what is it that you're seeing from a company business perspective? Where are you seeing traction?
Yeah, definitely. If you look at the high-end luxury segments, the supply has been very slow in the last 3 4 years, and the demand has gone up significantly. So that is why it's not interest rate sensitive. So definitely, the players like Oberoi Realty, which has a strong presence in the luxury segment, the DLF in the NCR region, then to some extent the Loda. So these companies have focused on the high luxury segments. So they are getting benefit from this kind of the demand supply mismatch that we are witnessing on the luxury segments. So this segment will continue to do good in the coming years because supply is very limited there. And secondly, because of high interest rate, there has been some sort of wait and watch kind of approach from the end user in the mid-income affordable segments. So that segment will see some traction again coming back because of a pause in the repo rate, and we'll see some recovery again going ahead. So these companies have been showing a strong pre-sales number, and the strong launches are there. Then there is a lot of business development opportunities there in the pipeline. So these companies will do well in the next 3 4 years in terms of earning visibility as well as a better balance sheet because of a strong cash flows. So we are positive on these companies like Oberoi Realty from an equity valuation perspective.
Right. Uh, Gulam, coming to you as well, let's take into consideration the momentum, right? What we've seen, as you mentioned, that yes, the growth rate is not as much as what we've seen as in luxury in comparison to the mid-sized as well as the affordable segment, but it's there. Now, are you expecting that momentum to continue in 2023, probably extending to 24 as well?
Well, there is no reason for me to believe otherwise. Especially last 2 quarters, when the rate hikes were coming one after the other,
Hmm.
there were a lot of these discussions that the way things are moving soon, real estate recovery, the path to recovery would actually see a poor result after these rate hikes, etc. And it may actually go back to 2 years back when the industry was in almost recessionary trends, etc. But in spite of those rate hikes, the number of transactions that we have seen, in fact, month on month, if I look at last 1 year's numbers, pretty much every month we have seen transactions looking better over the last whole year. So the January was the best of last almost 8 10 Januaries. February was in accordingly. We have month on month growth that we've been watching, and that hasn't really slowed down in spite of all those rate hikes. So almost 250 bips of rate hikes and no impact on the market. And that is giving us a lot of comfort. And the reason why, whatever I'm going to say now, is that I am drawing comfort that in spite of such a huge impact on affordability, the people are still queuing up to buy their apartments. That means in times to come, with either the pause or if at all there is a reversal possible, things will only improve. So from here, the way we look at it, we don't really see much of a concern for the industry per se, having taken so much of a rate hikes in its stride. Going forward, things will not turn around that much. And that said, it's also important to understand that the recent last 2 or 3 rate hikes, after that, the buyers who have walked in are the ones who are smart enough to understand that they're entering at the peak level. So whenever the turnaround or the reversal happens, they're better off compared to many others who would have taken the loans when the rate hikes were the lowest, which is about 6 point, I think, historical low we have reached. 6.25% of a home loan interest rate was unheard of in this country. We reached that. From that to where we are, almost 300 bips hike is a big number. But in spite of that, the transactions are going on. Now, one last factor, which if at all I would be worried about, is the price hikes, and which is absolutely with the developers. And fortunately, thus far, developers have proven this, that they are smart enough not to come in with crazy price hikes to kill the affordability. Please understand, every time the real estate cycle turns, whenever affordability goes for a toss, while affordability has multiple factors to it. On one side, you have wealth creation, whether it is increments in the salary in the packages, or you have earned a lot in the stock exchanges or equities or whatever else. So overall wealth creation is on one side. On the other side is home loan interest rates. And the third most important thing is the price of the product. So as long as developers are not going for crazy rate hikes, price hikes, appreciation of the property prices, we are not going to see any change in the fortunes of the industry. So overall, as long as affordability is in place, and mind you that I think last 2 years we've been looking at about 6.5-7% per annum kind of a price appreciation, which is if you're looking at net of inflation, it is still negative. So that is giving me comfort that as long as affordability is in place, the market is not going to see any pain. So going forward, since your question was specifically to answer your question, in next couple of quarters or at least a year, we are not unduly worried about how the sector is overall performing.
Right. Gulam, I'm going to come back to you on a pricing question next. But before that, Rupesh, coming to you, as Gulam was also mentioning that prices is a concern. Now, if you have to correlate this again, the inventory levels are down to 20 months from a 42-month that we had seen in 2018. If you have to take the demand and supply into consideration, price hikes of around 5 to 7 into consideration, how are you seeing from a valuation, a realization perspective, companies perform?
See, if you look at the 15 years back, from let's say 2005 to 2009, the most of the real estate players were getting a high premium to their NAV valuation, because there was a lot of the value was associated with the SPV or the land bank kind of a situation. But this time, the balance sheet, even in that previous cycle, the balance sheet were very stretched, like 3x kind of debt equity ratio. This time we are seeing just 0.4, 0.5 times kind of the debt equity ratio, which is very strong for these players. The secondly, there has been a lot of consolidation that has happening. The top 9 listed players, where the market share was around 10% earlier, is now contributing around 22%. So clearly, the whatever the demand is there, these companies are getting benefit from that. There's a lot of business opportunity. They are entering into asset-light model, so that will bring more return on equity, because they don't have to incur capex on the land bank acquisition, all those things. And this time, if you look at their expansion is toward on the residential side. So mix is they have been very conservative on the commercial side. So there has been the occupancy level that we have seen recently gone up. Then rental per square feet has gone up. So that is what this time there is been a very conservative and discipline is there in the market that will continue to benefit these top listed players going ahead. So overall, we are seeing that the recovery has just started 2 years back, and it will continue for next 3-4 years. The kind of demand, pent-up demand there in the system, and the supply has been is more from the large developers, and sort of a discipline is that we are observing in the real estate sector. So that will continue to benefit this place.
Right. So taking it from there, Gulam, my question is now, we're seeing a 5 to 7% appreciation in terms of where property prices go, right? Now, taking that point, is it a good investment bet from a real estate perspective? Because clearly, should it be an investment into real estate, or should it be an investment into real estate companies? That becomes a crucial question for an investor. How would you respond to that?
Look, I think the next aspect, investment into the company, is better left for Rupesh to answer. I would only focus on buying an apartment as an investment, because that's my domain. That's what I can convincingly talk about. And my answer is a vehement no. Let me be very clear. I have been saying so for a long time, that with the kind of property price appreciation, 6-7% per annum kind of a number that we're looking at, and that too in last year and a half or two. Prior to that, it was hardly any. It was next to zero. In fact, a lot of places, the property prices have actually come down. So in an environment like that, even considering investing in real estate with a negative return, because the moment I talk about inflation also kicking in, you're talking about a negative growth rate. And that is something which should keep you away. If you are an investor worth your salt, it is evident, with barely about, even if I look at, if I ignore inflation, 5-6% increase is not worth it. And especially for such an illiquid asset like real estate, it is not as if you can, stand up today and say, I will sell an apartment and send my daughter or son for the education tomorrow to Europe or somewhere. That won't happen. It'll take me months to get rid of this apartment that I have bought. So with that kind of an investment, I am of a proponent, you should not go for buying an apartment as an investment. A vehement no to that from my side.
Right. So that's a retail outlook, right? But when you talk about institutional investments that are coming in as well, that has been pretty strong overall. You see, I mean, good names like a Bain, or for example, for the likes of an Oak Tree, all of them have come in recently pretty strongly in the infrastructure real estate section. Now, do you think it's a phase where we are going to actually transition and see a lot of secondary market transactions happen where a lot of institution owned, or our portfolios are partially or fully divested from here on, Gulam?
Look, once again, if you're talking institutional buying, institutional purchases are happening in commercial or non-residential domain.
Right.
So since the focus was all this far was on residential sector, my answer was a strict no to buy an apartment. And institutions don't buy residential inventories. If at all they're doing it, it's mostly debt related, when they're investing or pumping capital into it as a debt and taking residential units as security. It's not an equity infusion or buying apartment per se. That is left for individual buyers. So now if you're focusing on institutional purchases or institutional money coming into real estate, even if it is coming into buying actual equity, that is going beyond residential. So you have, like, there are a few of such cases where in case of residential, say student housing could be one focus, but that's very, very rare. Hardly one or two investments I can think of. Most of capital from institutions are coming into office sector or retail sector, and these days warehousing has been blooming, has been doing very well. So all those sectors are getting lion's share of equity coming from most of these players, and that shall remain. And since most of those assets, I think we're talking about rental, worries on the office sector rental. Let me tell you, in spite of whatever is happening, whether it was the recession in the Europe and US as a question you are talking about, or the Ukraine-Russia war and so on, a lot of those headwinds, in spite of that, the office sector take-up, absorption is going pretty strong. And whatever said and done, office rentals have also notched up a bit. So in spite of whatever negatives are happening for office sector is not performing too bad. And that's a big comfort for such kind of institutional buyers, and especially when back in, say, Americas, etc., where the same office sector is performing pathetic. In fact, there are huge concerns that many of these large banks that have exposure to corporate real estate in those countries would be the next to fall. In spite of all that, Indian office sector is going strength by strength. It is going actually strong as we speak. So as institutional fundings coming into real estate, first of all, not towards residential. Whatever little coming in residential is also into organization, companies. It's not getting into projects or buying inventories. It's coming into companies. And once again, as I said, that's a domain where I would leave Rupesh to talk about.
No.
But overall, interest of institution in Indian real estate is thriving, not so much on residential, but the other asset classes.
Right. And overall, from a region-specific perspective, if you have to see in terms of residential, we have seen majorly it's Hyderabad, which is growing. Whereas if you see Mumbai, Bangalore, they've seen a marginal degrowth. What is that actually indicating, Gulam?
Well, I won't worry about this just 1 month or 2 months of data, because when as I said, the January of 2024 was very good in last 10 years. While it could be 1 or 2% below the January of 22, but still, we have to also see it in the right perspective. With so much of rate hikes and this and that, lot many things going wrong, this kind of number is actually heartening. So while you're talking about Hyderabad as an outlier, I would say it is not so much of an outlier, because the large markets are Mumbai, Delhi, and Bangalore.
Bangalore.
Hyderabad still has a very small market in terms of number of transactions, and value-wise, Mumbai is hands down the winner.
Hands down.
Just a small aberration here and there on a month of a data is not something which shall raise flags here, red flags here. So I would say let's hold back. The markets are in good shape. Just 1 month or two of data should not deter us from our positions.
Right. In fact, from what Gulam is saying, Rupesh, if you have to take, the regional specific companies into consideration, the numbers that are coming in, where would your bets be now from here on? If you even talk about, say, a Soba who's achieved the highest ever quarterly sales, plus they have launched 3 new residential projects as well. You have Lodha, which has gone ahead and achieved its best annual pre-sales. You have Godrej, which has again done a best everly quarterly and annual sales number. Similar is the case, we are awaiting data from Prestige, Oberoi, as well as Brigade, but the numbers are looking pretty good in terms of pre-sales. And if you have to take the demand and supply into consideration, the price hikes into consideration, realizations, where would your bets be then?
Clearly, we are still betting on the Bangalore market because steady growth there. It's purely driven by end user market, and the consolidation is already visible there. Only few players are getting benefit from the demand supply mismatch. And as I told you earlier, that this time the debt equity ratio is very, very comfortable as compared to previous cycles. The market is not giving high value to their NAV asset valuations. So still it is a 40-50%, in some cases it's 40-50% discount to NAV value. NAV value has already taken into just 3 to 4% kind of price hike. The input cost has been under control. So, and the discounting rate that we are assuming is around close to 12%. So we are being very conservative in giving a value to these companies. And still we find a lot of value there for these companies like Prestige, which are Bangalore based, now entered into Mumbai market as well. Then the Brigade is there, the mix of residential and commercial assets in their portfolio. Then Shobha. So we are positive on all these three companies with 40 to 50% kind of upside. We are valuing at just 1 times NAV value, not like 2x, 3x kind of premium to NAV value that we have seen in the 2005, 2009. That time we have seen crazy valuation for the real estate companies, but this time I think market is very fair and giving them just 1 times NAV value. So this company can give you around 40-50% kind of upside if you hold it for 1 or 2 years, because the steady growth, pre-sales number, the launches, the cash flow visibility there we are looking at, the land bank they have currently, all paid land bank. So a lot of opportunities are there, so they will grab this opportunity. So we are positive on the Bangalore market. And also, as sir said, that Mumbai is also every time's all-time very favorite market for the developers. But again, we are not expecting a price hike from the current levels that will get absorbed in the market. But even if we factor a steady the price appreciation from the current levels, I think these companies have a strong balance sheet, a strong project pipeline ahead. Free cash flow visibility is very strong. So these will companies like the Mahindra Lifespace, then we have Oberoi Realty, that will continue to gain the market share as well as investor interest also. So there also we are looking at close to 30-40% kind of upside from the current levels.
Right. So that's with regards to Bombay and Mumbai. Gulam, very lastly, any closing comments from the discussion that we've had, what an investor should listen to?
Well, I always maintain that for me, my focus is mostly B2C. I would rather advise individuals who are looking at getting into buying apartments, etc. Rupesh's domain is B2B. So, as I said, my advice to anybody who wants to invest in real estate is to focus on The office sector, if you can, enter into REITs, because that's one avenue which has just opened up and still cooking up. We have a long way to go ahead of REITs. Otherwise, the options are limited, because the kind of office sector involvement, you're creating huge offices. And for an individual small investor to participate in office sector, options are limited. But that said, you still can invest in other options like shops, etc., smaller units in your own housing colonies where you stay, and so on. So options are there. It is not as if real estate is not showing any option to small-time investors. You do have it.
Right.
But as I said earlier, I would I would warn you not to buy apartment thinking that you will get 2x
An investment.
value in next years. That is not going to repeat again.
Absolutely. Thank you, Zia. And thank you, Rupesh, so much for joining us on the show and giving us those views. It gives a well-rounded perspective to an investor as well as a buyer as well. Thank you. Stay safe and speak to you soon again.
Thank you. Take care.